Today we are going to understand all about gross profit and gross profit margin. We are going to see three aspects about gross profit and the gross profit margin calculation. And before we move ahead in this particular video, please remember, subscribe, like, and also share it to as many people as possible, your friends and close relatives, so that they can also gain from this financial education. So let's get back to our topic, the 3 points about gross profit and gross profit margin. So the first aspect about gross profit what we are going to see in this particular session is we are going to understand what is gross profit all about, how it is calculated. The second aspect about gross profit what we are going to see is why is it really important? What is the significance about gross profit and gross profit margin? Does it have relevance to our investing decisions or not? We are going to see that in the second topic. And the third aspect we're going to see is Mr. Warren Buffett actually using gross profit and gross profit margin calculation for his investment decision, yes or no? So we're going to see all these aspects, so watch it till the end. Do not miss the video at any point of time. So it is important for your financial education, being a amateur investor, or if you're just already started investing, you may not know all these aspects, so please continue watching. So the first aspect about gross profit margin is, what is gross profit? Gross profit is what remains in company's pocket after spending from the income on all the costs that are involved to produce this finished good. So as you know, the main reason of company's operation is to sell products or services in the market. As a result of selling cost, you remember back in school days, selling cost. So as a result of selling its product or services to the market, what it acquires is, through a selling cost, it acquires something called as the income or revenue or sales or turnover. So once you have this sales, turnover or income or revenue, we all know that the company has already expensed or spent to produce this final good by purchasing raw material from its suppliers. So the cost price, remember back in school days, the cost price is involved to actually produce this finished good. The cost price is what the company incurs to purchase from its suppliers all the raw material. So once the cost price is known, this is called as the expense which the company has incurred to purchase raw material. So this expense which is incurred for purchasing the raw materials and to produce this finished good, that is subtracted from the income or the revenue to give us the gross profit of the company. And from this gross profit, we are going to decide, or the company is going to decide what to do with that gross profit. It could spend on advertisement of the products. It could have an inventory of the product which it needs to sell. So it needs to advertise to different kind of people. So then subsequent costs will be involved. It would need to spend on the loans which it has taken. So from that gross profit, it would spend on the interest part of the loan. It could also spend on whatever expenditure it might have incurred for taking up the physical assets or non-physical assets. So all this later on are subtracted from the gross profit to give us something called as the net income, which we'll take up in a separate video anyway. So coming back to gross profit, we have now understood what is gross profit. We have understood how to calculate it as well. Just to reiterate, gross profit is what remains with the company after subtracting from the income the expenses that it has incurred on the cost of raw materials. So the calculation is already pretty much straightforward as mentioned in what I've just said a few minutes ago. So now let us say the second aspect. The second aspect is, why gross profit? Is it really required to take our investment decisions? Yes, my friend, it is very important to understand gross profit of the company to take our investment decisions. And I have been basing my investment decision on gross profit margins as well. So if you take it as a matter of fact, when you calculate gross profit margin, if the gross profit or the gross profit margin is less, then it actually indicates either a shortfall of revenue or shortfall of income of the company, or it could also mean that it has low bargaining power with its suppliers. So because of low bargaining power with its suppliers, the cost of good, whatever the company is purchasing from its suppliers, is tending to be high. So it's not able to get enough significant gross profit or gross profit margin. By the way, gross profit margin is calculated by just taking the gross profit calculation and dividing it by the sales or the turnover of the company. So that is the way gross profit margin is calculated. So now if this margin or the gross profit is high, it indicates two aspects again. Either the income could be very high or the revenue could be very high, or it could also mean that it has very strong bargaining power with its suppliers. It's able to negotiate a cost price for its raw materials in such a manner that it is so low compared to its peers and whatever it's actually earning by selling into the market. So it could mean two aspects. Either the company with a high profit margin is actually having a very good competitive advantage with respect to its peers, and something having a low gross profit margin or low gross profit, it means that it is an industry which everybody is competing with each other, and there's no really competitive advantage in that particular industry. Or it could mean that one person stands out in that particular group of companies. One particular company might stand out with respect to gross profit, which is having a very strong bargaining power with its suppliers, as well as it's able to increase its prices with respect to inflation, thereby keeping its income and the revenue stable enough to earn significant gross profit and gross profit margin. So what is that benchmark? So the third aspect, then before we look into the benchmark of gross profit and gross profit margin, we'll see the third aspect, is Warren Buffett really using gross profit margin? With all the books I have read so far, all the books whatever has been associated with Warren Buffett, they have all claimed that he uses gross profit to measure the company's moats. So when I say company's moats, obviously I've already explained in the second point that if the gross profit is high, that is the gross profit margin with respect to the sales, gross profit with respect to sales is high, then you have a company with a significant competitive edge. You have a company which is having a strong pricing power. Whenever the inflation rises, it's able to price its products or services in a way which people are able to pay as well. It's also able to have bargaining power with the suppliers in such a way that it keeps the cost of raw materials low enough to get a significant gross profit, and also the gross profit margin tends to be higher. So what is the benchmark? What is the benchmark which we need to apply with respect to gross profit margin? So a benchmark is always on a margin aspect, the percentage margin aspect, which is calculated by taking the gross profit, income minus the cost of goods sold. Whatever gross profit you get, that gross profit you divide back with the sales, that will give you the gross profit margin percentage. So this gross profit margin percentage should, in most cases for a company which is having a very strong competitive edge, should be 35% or 40% and above. And there are a lot of companies which are having this particular gross profit margin percentage which is more than 35% and above. Nevertheless, having said that there is a benchmark like 35% and above, well, in some particular industries, you might not have so high gross profit margin, but some particular company, for example, if you take a painting segment, you will see that Asian Paints have a higher gross profit margin with respect to all other companies in that particular industry. Isn't it amazing? So that's the reason why Asian Paints stands out in that group. I'm not promoting Asian Paints. It is just for a case study which I have taken. You can as well check out the gross profit margin. It may not be like 35 or 40%, but it is significantly higher compared to its peers. So gross profit margin, my friends, you have understood how it's calculated. Income minus the cost of raw materials, that's the way it's calculated. Gross profit margin is calculated by taking this gross profit and dividing by the total sales of the company. And then why it is significant? Because it indicates the company's competitive edge, competitive advantage. It indicates the company's moats. Is it having product that is worthwhile with the customers want to buy. So that indicates the company's moat of the products itself. And then finally, we know Warren Buffett uses it. So we should as well use it. Being amateur investors, we have to learn from somebody who is experienced using it and use it in our investment decision as well. So if you have liked this video, please share, subscribe, do not forget with all your friends and relatives. See you.